Hello everyone. Welcome to my workbook solutions videos for managerial accounting. This video covers Chapter 22, Evaluating Variances. Please note that if you are watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter, as the example problems we'll work through will still help explain the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier for you. Without further ado, let us proceed. Let's begin with a quick review of flexible budgets. Turn to page 4 to observe the following information for Mars Corporation. Mars Corporation incurs the following overhead costs to manufacture its product. Here you see the cost information for indirect materials and labor, supervisor salaries, depreciation, and utilities. Prepare a flexible overhead cost budget for the following production levels of 6,000 units, 8,000 units, and 10,000 units. The cost can be categorized into variable costs and fixed costs. Utilities carries both a variable and a fixed cost component. The flexible budget will convey the cost amounts for 3 specific levels of production. Starting with variable costs, we'll determine the aggregate amounts for indirect materials, indirect labor, and the variable portion of utilities. Indirect materials has a per unit cost of $2. Multiply that per unit cost by each production level of 6,000, 8,000, and 10,000 units, and the total indirect materials cost will be $12,000, $16,000, and $20,000 respectively. Indirect labor has a per unit cost of $1.50. So repeat the process performed for indirect materials. Multiply $1.50 per unit by 6,000, 8,000, and 10,000 units. And the total indirect labor cost will be $9,000, $12,000, and $15,000. The per unit cost for utilities is 25 cents. So multiply that amount by the 3 production levels, and the result is the total variable cost for utilities. The total of variable costs will be $22,500 for 6,000 units, $30,000 for 8,000 units, and $37,500 for 10,000 units. Now we can list the fixed costs. Fixed costs don't change, so we list the 3 categories of such costs, and their amounts will be the same under each production level. The total of fixed costs will be $145,000 regardless of units produced. Combine the totals of variable and fixed costs to get total overhead costs. Turn over to page 6 and let's calculate some variances. Brassworks Incorporated produces brass lamps and gift products. Engineers at Brassworks have established the following direct material standards to produce a brass candelabra. Direct material standard of 1 pound of materials at $5 per pound. During April, Brassworks used 1,050 pounds of direct materials at an actual cost of $5.40 per pound to make 1,000 candelabras. Compute the following variances: the direct materials price variance, the direct materials quantity variance, and the total direct materials variance. Starting with the direct materials price variance, take the difference between the actual unit price and the standard unit price, then multiply that amount by the actual quantity. The actual price is $5.40 per pound. The standard price is $5 per pound. Take that difference of 40 cents and multiply it by the actual quantity, 1,050 pounds. The variance will be $420. Favorable or unfavorable? Unfavorable because the actual price is greater than what was budgeted. Next, we'll do the direct materials quantity variance, which is the difference between the actual and standard quantities, multiplied by the standard price. The actual quantity is 1,050 pounds. The standard quantity is the product of the standard pound of materials per candelabra times the 1,000 candelabras produced, or 1,000 pounds. Multiply this 50-pound difference by the standard price. $5 per pound. This yields a $250 unfavorable or favorable variance. Again, unfavorable because the actual quantity used is greater than the standard quantity we should have used. Number 3. We can now calculate the total direct materials variance, which comes out to a $670 unfavorable or favorable variance. Because both the price and quantity variances are unfavorable, their combined variance is also unfavorable. Your workbook asks for possible causes of these variances. For the price variance, the price may have increased due to inflation, using higher quality materials, or supply shortages. The unfavorable quantity variance could be the result of production inefficiencies, materials not being to specification, or using lower quality materials that result in a lot of waste. Turn over to page 7 and attempt the direct labor variances. Brassworks Incorporated produces brass lamps and gift products. Engineers at Brassworks have established the following direct labor standards to produce a brass candelabra. Direct material standard of 2 hours at $10 per hour. During April, Brassworks used 2,380 hours of direct labor time to make 1,000 candelabras. The actual wage rate paid was $9 per hour. Compute the following variances: the direct labor rate variance, the direct labor efficiency variance, and the total direct labor variance. Beginning with the direct labor rate variance, this item is analogous to the price variance for materials, just with some different terminology. Instead of comparing the actual to standard materials price, we do so with the pay rate. Then, multiply that difference by the actual hours as opposed to the actual material quantity used. The actual rate is $9 per hour. The standard rate is $10 per hour. Actual labor hours are 2,380, giving a rate variance of $2,380. Favorable because the actual rate paid is less than the standard. Number 2, the direct labor efficiency variance is the difference between the actual and standard hours multiplied by the standard rate. Actual hours are 2,380. Standard hours are 2,000. The 1,000 candelabras manufactured times the 2 hours of labor per unit. The standard rate is $10 per hour, yielding a $3,800 unfavorable variance due to the actual labor hours being more than the standard hours. Number 3, the total direct labor rate variance will therefore be a $1,420 unfavorable variance. As for potential causes, the favorable rate variance could be a result of lower skilled labor or a surplus in the job market depressing wages. For the efficiency variance, the unfavorable variance could be the result of using lower quality materials, low skilled labor, or aging machinery. Let's skip ahead a few pages to page 14 and tackle Brassworks overhead variances. At the beginning of the current year, Brassworks Incorporated estimates its overhead cost and normal capacity as follows. Annual fixed overhead, $90,000. Annual variable overhead, $195,000. Direct labor hours at 100% of normal capacity, 30,000 hours. During the month of April, Brassworks produced 1,000 candelabras. The standard direct labor time is 2 hours per candelabra. Actual fixed overhead costs were $7,500 and actual variable overhead costs were $16,000. Compute the following variances: the variable overhead controllable variance, the fixed overhead volume variance, and the total overhead variance. Number 1, compute the variable overhead controllable variance. Before we go any further, we need to calculate our overhead rates. The variable overhead rate is straightforward. We have a budgeted annual variable overhead of $195,000 along with a budgeted annual activity base of 30,000 hours. So divide the former by the latter to get a variable overhead rate of $6.50 per hour. As long as we're here, let's also figure out the fixed overhead rate. The process is similar to what we just did. Divide the $90,000 of annual fixed overhead by the annual budget of 30,000 labor hours to get a rate of $3 an hour. Note that your variable and fixed overhead rates should sum to the total overhead rate for the year. That is, the total overhead of $285,000 divided by 30,000 hours. As for calculating the variable overhead controllable variance, that amount is the difference between the actual variable overhead and the budgeted variable overhead for the actual production level. Actual variable overhead is given as $16,000. To get the budgeted variable overhead for actual production, we start with the 1,000 candelabras produced for the month. Then multiply it by the standard rate of 2 hours per unit to get total hours that should have been spent in manufacturing. Next, multiply that product by the variable overhead rate of $6.50 an hour to convert those budgeted hours into a dollar value. How much variable overhead should have been budgeted for these 1,000 candelabras? $13,000. The variance is thus $3,000, but is it favorable or unfavorable? Because the actual variable overhead is greater than what we should have budgeted, the variance is unfavorable. Number 2, the fixed overhead volume variance. This variance is the difference between standard hours at 100% of normal capacity and standard hours at actual capacity times the fixed overhead rate. The information gives us budgeted labor hours at 30,000, but this amount is for the entire year. In contrast, we're calculating this variance for a single month. To get the standard hours at 100% of normal capacity for April, divide those 30,000 hours by 12. The standard hours at actual capacity is the 1,000 candelabras manufactured times the standard rate of 2 hours per unit, or 2,000 hours. Multiply that difference by $3 an hour, and the fixed overhead variance is $1,500. Favorable or unfavorable? Unfavorable, because we produced less units than normal capacity. If we produce more than the normal capacity, that would be favorable because we were able to produce more than we intended with this fixed cost, meaning we operated more efficiently. If you need help remembering, think of it as follows. Imagine you have a fixed cost of $1,000. For the period, you expected to be able to produce 100 units with that money. That cost won't change regardless of how much you produce, whether it's 1 unit or a million. So if you're actually able to produce 120 units with that $1,000, that's good. You'll have a lower fixed cost per unit than you anticipated. However, if instead you were only able to produce 80 units with that $1,000, that's bad, because you'll have a higher fixed cost per unit than expected. Finally, we can calculate the total overhead variance. We had a variable overhead controllable variance of $3,000 unfavorable, and a fixed overhead volume variance of $1,500 unfavorable. So the total overhead variance will be a $4,500 unfavorable variance. Turn over to page 15. Here we see the information for Mackinac Incorporated, which processes a base chemical into a plastic. Standard costs and actual costs for materials, labor, and overhead incurred for the manufacture of 40,000 units are as follows. Here you see the standard and actual costs for direct materials. The standard is 120,000 pounds at $3.20 per pound. The actual is 118,500 pounds at $3.25 per pound. Direct labor has a standard cost of 12,000 hours at $24.40 an hour and an actual cost of 11,700 hours at $25 an hour. The standard factory overhead rates are based on 100% of normal capacity of 15,000 direct labor hours. Those rates are $8 an hour for variable costs and $10 an hour for fixed costs. The actual total costs for variable and fixed costs are $91,200 and $150,000 respectively. Each unit requires 30% of a direct labor hour. Let's figure out the direct materials variances, price, quantity, and total, the direct labor variances, rate, efficiency, and total, and the overhead variances, variable, controllable, fixed volume, and total. The good news is that the variance calculations are the same from one problem to another. If you're feeling ambitious, pause this video and try to calculate those items on your own. If you have the workbook, you have a template for your work on the next 2 pages. Let's start with letter A, the direct materials price variances. If you're using the template, you have the actual cost calculation on the left, actual quantity times actual price, and the standard cost calculation on the right, standard quantity times the standard price. To get our variances, we will compare these numbers to the actual quantity times the standard price. This is how much the actual production level should have cost based upon the standard price. Actual costs are 118,500 pounds times $3.25 per pound, or $385,125. Standard costs are 120,000 pounds times $3.20 per pound, or $384,000. Actual quantity times standard price is 118,500 pounds times $3.20 per pound, or $379,200. The difference between what Mackinac actually paid and what it should have paid is the direct materials price variance of $5,925. Is this variance favorable or unfavorable? Unfavorable. Compare the actual price to the standard price. The actual price of $3.25 per pound is greater than the standard price of $3.20 per pound, so we paid more than we planned. That makes the variance unfavorable. The difference between the standard cost and what we should have paid at the actual production level is the direct materials quantity variance, or $4,800. Favorable or unfavorable? This one is favorable. Here we compare the standard amount of materials used to the amount of materials we should have used. In this case, the actual quantity is less than the standard quantity, meaning we were able to produce these 40,000 units with less materials than we planned. That makes this variance favorable. Combine the price with the quantity variance to get the total direct materials variance of $1,125 unfavorable. The unfavorable variance associated with the price exceeds the favorable variance associated with the quantity used, so the total variance nets as unfavorable. If you don't have the workbook, or if you attempted these calculations using the previously supplied formulas, they would yield the same results. The standard and actual cost per pound are $3.20 and $3.25. The actual quantity is 118,500 pounds. Multiply that difference to get $5,925, the very amount we calculated using the workbook template. Again, this variance is unfavorable because the actual price is greater than the standard price. The direct materials quantity variance is the difference between the actual and standard quantity times the standard price. The standard and actual quantities are 120,000 pounds and 118,500 pounds respectively. Multiply that difference by the standard cost per pound of $3.20. The math works out to $4,800 favorable. Again, the actual quantity of materials used is less than how much we anticipated using. Now we will address the direct labor price variances. The computations are analogous to those you did for the materials variances. The actual cost is the actual hours times the actual rate, or 11,700 hours times $25 per hour, $292,500. The standard cost is the standard hours of 12,000 times the standard rate of $24.40 an hour, or 292,800 hours. The actual hours at the standard rate is how much we should have paid using the expected labor rate for the actual hours worked by Mackinac employees. 11,700 hours times $24.40 an hour, or $285,480. The difference between the actual and standard rates for the actual hours worked is the direct labor rate variance, or $7,020. Is this variance favorable or unfavorable? Unfavorable. This is because the actual rate is greater than the standard rate. What Mackinac actually paid is greater than what it expected to pay. The difference between the actual and standard hours across the standard rate is the direct materials quantity variance, $7,320. Favorable or unfavorable? Favorable. The actual hours worked by the employees is less than the standard hours. Mackinac's employees were able to manufacture these 40,000 units in less time than expected. The total direct labor variance will be $300 favorable. Of course, you could have determined these amounts using the formulas. Take the difference of the actual rate and the standard rate, 60 cents. Then multiply it by the actual hours of 11,700. The result is still $7,020 unfavorable because the actual rate is greater than the standard rate. The direct labor efficiency variance compares to the direct materials quantity variance. Take the difference between the actual and standard quantities, then multiply it by the standard labor rate of $24.40 an hour. The variance is $7,320 favorable because the actual labor hours are less than the standard labor hours. Finally, let's do item C, the overhead variances. I'm going to need a little more space for these calculations, so allow me to make some room. Here's all the pertinent information we need. Starting with the variable overhead controllable variance, the difference of the actual variable overhead for the period less the overhead that should have been budgeted for the actual production level. The actual variable overhead is $91,200. To get the flexible budget variable overhead, take the 40,000 units then multiply them by the standard 0.3 hours of direct labor per unit. Then multiply them by the variable overhead rate of $8 an hour to get $96,000. Subtract this number from $91,200. And the variable overhead balance will be $4,800. Favorable or unfavorable? Favorable, because the actual variable overhead is less than what we budgeted. Next, we can do the fixed overhead volume variance. This item is the difference between standard hours at 100% of normal capacity less standard hours at actual capacity times the fixed overhead rate. The standard hours at normal capacity are 15,000. To get standard hours for actual capacity, multiply the 40,000 units by the 0.3 hours per unit, or 12,000 hours. The fixed overhead rate is $10 per hour, yielding a total fixed overhead volume variance of $30,000. Is this variance favorable or unfavorable? Unfavorable, because actual capacity is less than normal capacity. We are not producing as much as we expected, so the fixed cost per unit produced is going to be higher than anticipated. If we combine the variable and fixed overhead variances, we get a $25,200 unfavorable variance. I realize this is a fairly substantial variance, but such is how this problem worked out. The primary drivers being the $10 fixed overhead rate and the size of the difference between normal production and actual production. That aside, hopefully you now understand how all these types of problems are worked. Turn to pages 18 and 19. I want to run through recording journal entries with variances, and more importantly, give you some tricks to handle such problems expeditiously. Please be aware that this example is a continuation of the previous Brassworks examples shown earlier in this video. If I reference an amount nowhere on the screen, you can find it on those previous pages of your workbook. Brassworks used 1,050 pounds of direct materials that cost $5.40 per pound. The effect of paying 40 cents more per pound than the standard was a $420 unfavorable price variance. Record the purchase of the materials. The basic entry for purchase of materials consists of a debit to materials inventory and a credit to accounts payable. Accounts payable will be credited for the actual quantity times the actual price. This product provides the monetary value we owe. Our vendor doesn't care at all about our variances. Its payable balance needs to convey what we are going to pay. Brassworks purchased and used 1,050 pounds at $5.40 per pound. So this credit is $5,670. Materials inventory receives a debit of the actual quantity times the standard price. The actual pounds of brass purchased is the actual pounds purchased, but we put this quantity in this account at its standard price, the price Brassworks should have paid for this amount of material. The actual price is 40 cents more than the standard price, so we multiply the 1,050 pounds by $5 per pound. This debit will be $5,250. Which materials variance are we going to record, the price or the quantity? Notice that the quantity is consistent between our two accounts. However, their respective prices are different, so we'll record the direct materials price variance, the actual quantity times the difference between those prices. Because the actual price we're paying is greater than the standard price, this variance is unfavorable. Unfavorable variances are recorded with debits. Effectively, they function as expenses. At the bottom of page 18, record our materials usage. Brassworks used 1,050 pounds of direct materials for production when the standard materials quantity was only 1,000 pounds. Record the requisition of materials into production. The entry to record materials put into production is a debit to work in process inventory and a credit to materials inventory. Materials inventory will be credited for the actual quantity times the standard price. Again, the actual quantity of brass taken out of this account needs to be reflected, and since it was put in this account at the standard price, it needs to be taken out of this account at the standard price. The calculation will be 1,050 pounds times $5 per pound. Work in process inventory is debited for the standard quantity times the standard price. In other words, we are recording the quantity that should have been put into production at the cost we should have paid for it. This amount will be 1,000 pounds times $5 per pound. To figure which variance we will record here, notice how the prices are identical. However, the quantities are not, so we will record the direct materials quantity variance, the difference between the actual and standard materials quantities times the standard price. Because Brassworks used more materials than it intended, this variance is unfavorable. Like in the previous example, the debit functions as an expense. On page 19, let's record the labor costs. Brassworks incurred 2,380 direct labor hours at a cost of $9 per hour. The standard was 2,000 hours at $10 per hour. Record the payroll entry to record direct labor wages. The entry to record labor costs will debit work in process inventory and credit wages payable. Like accounts payable, wages payable gets the actual hours times the actual rate. We need to record the actual amount we will pay in our payables. Work in process inventory gets the standard hours times the standard rate, just like it was debited in the previous entry. We record the hours we should have used in production multiplied by the wage rate we should have paid. Unlike materials, we don't buy labor and then use it later, so this entry will record both labor variances within it. How will each of these variances be recorded? By that I mean, how do we know if we'll debit or credit them? You can deduce this fact by comparing your actuals to your standards. The actual labor rate is $9 an hour, but the standard is $10 an hour. Because the actual rate is lower than what we intended to pay, the direct labor rate variance will be a credit. Because this variance is favorable, it gets a credit like a revenue. For the efficiency variance, the actual hours incurred is greater than the hours we should have incurred, so the efficiency variance is unfavorable, meaning it will be recorded with a debit. Now we can start recording the amounts. The actual hours times the actual rate is 2,380 hours times $9 an hour, or $21,420. The standard hours times the standard rate is 2,000 hours times $10 an hour, or $20,000. How do we calculate the amounts for our variances? One way is to recall their formulas, but if you're having difficulty doing so, you can do the following. Starting with the rate variance, remember that this variance is analogous to the price variance for materials, so you can look back at that entry. When we recorded the price variance, we used the actual amount times the difference between costs. So we will do the same thing for the rate variance. Multiply the actual hours of 2,380 by the $1 difference between the actual and standard rate. The amount, 2,380. You can do the same thing for the efficiency variance. Look back at how the quantity variance was recorded for materials. For the materials quantity variance, the materials usage difference was multiplied by the standard price. Consequently, for the direct labor efficiency variance, we'll multiply the difference in hours by the standard $10 per hour. Again, because the actual hours are greater than the standard hours, this variance is unfavorable, so it is recorded with a debit, akin to an expense. Here you see the three previous entries with their variances. Here's three simple rules for how these entries are recorded. Your credits to payables are always the actual amount times the actual cost. That product is what we must pay our employees or our vendors, regardless of any variances. Work in process inventory receives the standard amount times the standard cost. Effectively, we record work in process at the cost of labor or materials we should have incurred. Materials inventory always receives the actual quantity times the standard price. The debits and credits in this account must be based on the actual quantity of materials bought or used. If we bought 1,000 pounds of materials or used 300 pounds of said materials, that's how much has been added or taken out of this account. But convert the pounds acquired or used to a dollar value at the standard cost. These numbers are the costs that should have been recorded based upon the actual activity. From there, you can plug your variances, remembering to debit unfavorable variances while crediting those that are favorable. You won't be able to plug the labor variances since both variances are contained in the same entry, but you can reverse engineer their formulas by looking at their counterparts in the materials entries. For instance, the direct labor efficiency variance is calculated in the same manner as the direct materials quantity variance, which multiplies the standard price by the difference in quantity. Therefore, the direct labor efficiency variance will also be the standard cost multiplied by the difference in quantity. Though the cost is the rate and the quantity is the hours. For the direct labor rate variance, look at the direct materials price variance. This variance multiplies the actual quantity by the difference in price. Therefore, the direct labor rate variance will also be the actual quantity times the difference in price. Just substitute hours for quantity and rate for price. That concludes this video. There may be a couple of problems in the workbook I didn't cover. If so, you can find their solutions in the course module on Blackboard. I encourage you to try them on your own to test your retention of the material. Please let me know if you have any questions. Thank you for watching.